This is Satya Pratyuman of Cirrus Research. I want to call your attention to the latest Cirrus dispatch. It's our quarterly outlook report. The title is A Barbelled Approach to Walk the Inflation-Recession Tightrope. In this past quarter, and in fact, year to date, we've seen a very dramatic sell-off in markets. Investors have truly struggled with this idea of a rampant pickup in inflation, and most recently and adversely, the likelihood of an increasing recession risk. In this report, we walk through a few of the key items on how we would be positioned in this kind of a marketplace. One, the profit cycle is indeed peaking. That's fairly clear. As a result, we are continuing to really focus on higher quality firms. We think they will continue to outperform, especially as the profit cycle continues to slow. Part two is that this idea of risk aversion, it's quite constructive for equity markets. We've seen a lot of our risk appetite measures collapse to structural lows. The idea, though, and the risk that remains is that we feel that this could continue to spread through to the larger cap names. A lot of the damage done in the most speculative names have taken place for over 18 months. More recently, we've begun to see this ripple through to the larger mega cap shares. The next point that we focus on here is the earnings-driven market that we're in, that the fading forecast will continue to be a good pointer for where markets are going. In short, we continue to be cautious about the earnings environment. The estimates have been ratcheted back, but they're far from some sort of a recession-type low, and we think that's going to be important to watch here. The other key points about valuations is they have begun to contract from decade-long highs. The large cap multiples relative to small are incredibly aggressive. So this is something that we're going to see. If there's more rate risk here, it certainly will continue to come really affront the most sizable names. The second part is the relative valuations of small. Equity markets are rich, but we're also looking at structurally discounted small cap markets. No place is that more dramatic than in the small cap growth arena because of the small innovation stocks that have broken. This chart here represents the gap, the performance gap between one proxy for innovation stocks using the ARC product, and the blue line represents the extended FANG. So what we're seeing is some correlation between the two relationships, but clearly we could see this continue to narrow, the gap continue to narrow. Down below, it gives you a reality check on where the valuation gap is really for the extreme small cap innovation names. They've really come back, traced back quite a bit from the peak of 15 times all the way back down to 4 times. We continue, as I say, to underscore the need for higher quality. Profit cycle in the purple line, clearly it is peaking. It is going to slow. And the blue line represents the forward estimates coming down. That said, these numbers could go quite a bit lower before the market feels it's priced in the weakness at hand. And then finally, how to put this to work. We're using, on the growth front, the quality growth to GARP-related models. Why? Because of everything we've seen, the idea that you want more earnings visibility in your stock selection effort. And at the same time, we want valuations to be reasonable because there is rate risk. Down below on the value front, similar ideas. The bottom line here is that we continue to lean towards this quality metric. Take a look at the report. Be happy to take any questions, and feel free to reach out to us. Thank you.